Good morning, good afternoon, and good day to you. My name is Carter Froelich, and I'm with the Property Ledger, bringing you another series in our education tutorials related to real estate investing. Today's topic is how much tax do I have to pay on my property and the determination of taxable income. And it's somewhat of a depressing topic because I'm sure nobody likes to pay taxes, but it's truly the world in which we live in. And if we are paying taxes, that means we are in fact making money. So let's get right into today's subject, shall we? And take a look at the net operating income versus taxable income. And the formula for taxable income begins with our net operating income. And from that, we're going to be backing out the interest on any borrowings that we have on our property. We're going to be subtracting depreciation, and we're going to get into that concept in just a minute. And then we're also subtracting amortization on any of various soft costs. So we have one of the most common are points that we paid to originate our loan. And that brings us to our taxable income. So you can see we're actually starting with our net operating income. We're deducting some additional items, some of which involve cash outflows, others do not, to come up with our taxable income. Let's take a look at some of these deductions, shall we? Well, the first is interest. And to the extent that we're borrowing money to acquire property or to acquire property and then maybe take out a second to actually improve that property, we're able to take the interest component or the amount that we're paying every month in interest and deduct that from our NOI to determine our taxable income. The second item that can, and one of the reasons and one of the actual benefits of real estate ownership is depreciation. And the federal government allows us to take the cost of our real estate investment and deduct that over a specific time period depending upon whether we're looking at residential or commercial. Now, the one thing that we have to keep in mind with depreciation is that we cannot depreciate land value. So say for instance if we purchase a house for $100,000 and we've determined that the value of that lot on which the house resides is $20,000, what we would do is take the $20,000 from the 100 to come up with a depreciable value for our single family home of $80,000. That $80,000 then would be divided by 27 and a half years to produce the amount of depreciation that we could deduct each year from our net operating income as a recognition that of over time this asset will be losing its useful life, and we want to recognize that against the income that it's producing. For the commercial buildings, it's 39 years, but the same concept applies. And then the last item that we're allowed to deduct to determine our taxable income is amortization. This tip applies to primarily soft costs, the majority of which relate to points on loans that we have taken out on this property, and those are typically amortized over the life of the loan. So let's take a look at taxable income versus cash flow, shall we? Beginning with taxable income, we have our formula again, as we indicated before. It's the net operating income minus the interest paid on borrowings, less our depreciation allowance on an annual basis, less our amortization equals taxable income. Now, taxable income is different from cash flow based on the following. Cash flow is really nothing more than the cash that you have available at the end of the day. If you carry a checkbook, you know what cash flow is like. It's nothing more than your inflows minus your outflows. So if you take a look at your cash flow, it's your net operating income less the total debt service that you have paid, but that's both principal and interest that you have made on your property, less any capital expenditures, equals your cash flow before taxes. And then obviously, if we're determining the taxes we would be paying, it's based upon your taxable income. So these are two real important concepts that you need to take into consideration. All begin with the concept of net operating income. Now, if you're not familiar with the concept of net operating income, I really encourage you to go back and take a look at our video on that subject so that you can bring yourself up to speed, because these are all three very important concepts that we're going to be returning to again and again as we continue to build our basis on our educational journey that we're on as it relates to real estate investing, and that is net operating income, the calculation of taxable income, and the calculation of cash flow. We hope this has been a valuable presentation to you, and we encourage you to keep on with your education as it relates to real estate investing. This is Carter Froelich signing off. Thank you very much.